All right. Hello, everybody, and welcome to Selfwealth Live, the technical analysis edition here. Here for another week, being the 3rd of December, 2024. Not far from the end of the year, which is exciting. How are you, Jason? How's things with yourself?
Hey, Roger, I'm all pretty good. Watching the markets move around a bit, which is interesting as it always is. So we can talk a bit about all of that. But all in all, yeah, I'm pretty well.
Yeah, very good. It's interesting you're saying moving around. I was looking at it before, and it's just edging bit by bit higher, but nothing, no real breakouts at the moment still. It's a very slow running, I think, in my eyes, but not too much activity. Maybe people are just going on Christmas holidays earlier, obviously. So, but we'll chat about that, what it looks like on the charts. Obviously, welcome to all our viewers once again. Love seeing you back, coming back week after week. If there is any new people here, we tend to analyze the markets and your stocks. If you want to send us your stocks from a charting perspective, from a price charts perspective, not too much around the fundamentals, because there's plenty of shows that show that. So we sort of a little bit unique in that way. Not a lot of shows will analyze stocks from a price chart perspective. So that's our strong point, right? And then any general questions, obviously, feel free to ask them in the chat. And then then is your time to we'll go through your tickers that you've come up for us to analyze your companies. All right, so feel free to start putting them in the chat as well. And we've obviously got another great show ahead with a general question from a viewer as well. All right, a long time viewer. But before we go with that, Jace, let's have a look at that disclaimer for us, if that's okay, please.
Yeah, so just quickly, everything we do today is general commentary only, no personal advice. And this disclaimer outlines all of that. I'm also not part of Selfwealth. I'm from Motion Trader. That's my business. And you see my details at the top, all the licensing, etc. And Selfwealth is beneath that. Again, licensing, general commentary, no personal advice. It's all in there.
Beautiful. All right. So let's get going. Just before I get going though, Jace, when do you go on holiday? Are you going before Christmas this year? From the markets, I'm saying, not with Joe, but from the markets. Do you ever take time off, away from the markets?
Yeah, I do. And like the great thing now is because we've got internet and all the data. Do I have you, Rog?
Can you hear me? All good?
Yeah, I got you, Rog. Yeah, looks like we have some internet issues. Roger, we there? Yeah, I think we may be having trouble with Roger's connection.
Got me. Yep, good. Sorry.
Today.
That's okay. All right, we'll keep on going.
Yeah. Okay, we got you there, Rog. Okay, yeah. So look, the beauty of the using all the internet now is that, and also having the approach I use is very much end of day data. So it doesn't involve having to watch the screens all day long. So yeah, I take time off. I do other things through the day. Then I can check in with what the price action is doing in relation to the trading rules that I have. And so it makes trading now very different to what it was when I started in the markets, when I was looking at the screen all day. It's very much a systematic approach. Get those rules, get the data, and taking time off whenever there's something else which is worth doing. So I think I've got you back there, Rog.
Yeah, it got me back. Sorry, look, I got a feeling this is going to be one of these days with the internet connection that I've got right now. Right, so it was in the morning we're having a few issues, but I'm doing my best here. So if I do drop out, have some patience. I appreciate. Jace will keep on running with the show. I'm sure he does a great job of it. Right, so as we both do. I hope everyone can hear me okay. All right, let's get straight into it then, Jace. Let's have a look at that Aussie market that's just edging bit by bit higher.
Right. Okay. So let's start with the ASX 200. So there we go, up on the screen, the ASX 200, and another all-time high for the ASX 200 this week, yesterday. And this was actually in the overnight session when the ASX 200 hit its all-time high. During the day session, didn't get there. That happened. I looked at an hourly chart earlier, and it was around probably around 10, 11, 12 o'clock during the US, as the US markets were opening, that the ASX 200 got that all-time high, and of course has opened higher today. So this very much, I think, keeps that bullish trend from earlier in the year very, very much in place. I've been pointing this out a lot lately, and I pointed out because it's an important thing just to really embed in our minds what the things that we look at, and this is that the ASX 200 has been rising, and it's been rising with the 50 and the 100-day moving average moving up with it, and of course price is above the moving averages. So for me, this is a textbook bullish situation, and it's not just a new thing. It's been the case for the last 12 months. So if you think back over the last 12 months, there've been some scares, there's been some periods where not much was going on, but the underlying condition in the market this year has been positive. So I think our approach really for the last year has been actively looking to buy stocks which are in upward trends and staying with those trends, and that's what's been producing some good results. Also important to note that prices, they're not overly stretched above the 50-day moving average. Sometimes we see prices really pull away from the 50-day moving average. That's not the case at the moment. So I think this is a sign that the market isn't getting carried away on bullish optimism. We have an upward trend, but it's not a euphoric trend where the price just really accelerates away. Rather, it's been steadily rising, and it's been an orderly advance. Plenty of doubters along the way. Plenty of people saying, "Look, the market can't keep going higher," and that's been the case all year, and it always is the case. There's always people who try to pick tops in markets, say it can't continue, but often we find that upward trends do endure for a lot longer than people expect. So for me, it seems like the classic case of you might be familiar with the old saying, it's called climbing a wall of worry, and it's how bull markets tend to advance. They climb a wall of worry with plenty of reasons why people suggest maybe it can't go on, but it climbs that wall of worry, continues upwards. So as I say, I think the overall structure here is positive. I had been thinking just over the last week or two, I had been thinking that maybe we get some sort of consolidation, maybe a week or two of just pause and work while the moving averages catch up. But that's not playing out with the market moving to new high. I'll show you why I was thinking that maybe we'd get a little bit of consolidation. I'll jump over to so this is the ASX 200. I'm going to jump over the ASX 200 on an equal weighted index. So this is where the largest stock and the smaller stock within that top 200 have the same weighting. And what I was looking at over the last week was prices, like, just quickly going back to the ASX 200, you can see prices made a new all-time high a couple of weeks ago, come over to the equal weight, and a couple of weeks back, the ASX 200 equal weight wasn't getting up to those previous highs. Still hasn't made a new all-time high for that matter. And I thought maybe that was a sign that maybe the market just wasn't quite ready to sustain a push to the upside. I thought maybe we get that consolidation, but look, as I say, the consolidation hasn't been playing out. And even having said that, the overall structure here is bullish. We've still got those rising moving averages, prices above the averages. So it's very much a market that I think we want to approach from the long side, but it's also just being prepared for those consolidations if and when they happen. But with this momentum in the equal weight starting to come back in now, that short-term concern no longer appears to be an issue. The equal weight is now on the cusp of making a new all-time high. So I think that's an underlying positive. The way I've been approaching this has been to maintain exposure to the market, and that's been the case all year. And I think we should continue to be working on the basis that that this is a bull market until we have until proven otherwise. And to be proven otherwise, price needs to break down below the moving averages. Moving averages need to turn down. It's not something that happens in a day or two. So whilst the conditions remain underlying bullish, I think that's the way we approach the market. All too often, I see people, just go back over to the ASX 200, all too often I see people looking for tops in the market. It's been interesting during this year. Lots of times people have been calling for tops in the market. The problem with calling a top is what happens when you're wrong. So it's great to call a top and be right and the market pulls back. What happens when you call a top and you're wrong and the market keeps going higher? And that's often what I see happen. So what I do, rather than trying to preempt a top, I use, we talk about this a bit, Rog, I use a trailing stop. Those trailing stops, it's an essential part of my strategy for staying on these big trends, not getting shaken out by the pullbacks and the consolidations that we get along the way. And as I was thinking the last week, I was looking for a pause. It hasn't turned out. The market's made a new all-time high, but that's okay because I haven't sold all my stocks looking for that to happen. I've stayed with the trend, stayed with that underlying trend, use those wide trailing stops. They keep me in a rising market. So it doesn't matter if the market doesn't pause and it keeps rising. I'm still in. And if we do see pauses along the way, which we always do, the wide stops just help see off those mild consolidations, keep you on the trend. But when the situation does ultimately deteriorate and you get a bigger decline, well, then you got your exit strategy. It gets you out when the market does ultimately take that larger turn to the downside. So for me, it's a bit of I think trailing stops, for me, I'd describe them as a bit of an all-weather plan or an all-weather strategy. So they help you maximize profits in the good times and they help you manage risk and get you out when things change. And I think that remains the play in this current setting.
Yeah, well, we've pretty much been talking this way the whole year. So if you've been watching the show and you're maintaining those stocks, it's good on you. And I think the wall of worry, I like that saying as well. I've never heard of it. But because of the system that we're running and the system we use, I don't really worry as much because for the sake of 15 to 20 minutes a day of checking my stocks, I can always put in a defensive move if something goes against me, right? So, it's good to be on that side of the educational path and not being worried too much about your portfolio at this point, right? So good on you there, Jace. Let's have a look at the US market then.
Okay, so let's jump over to the S&P 500, and it's been making some modest gains through the week. New all-time high on Friday, followed that up again on Monday with another just slightly tapped to a new all-time high. Generally, though, it remains near the highs from shortly after the election. It's only really just fractionally above those post-election highs. Looking at the NASDAQ, I'll jump over to the NASDAQ, and NASDAQ hasn't even quite made it back to the post-election all-time highs as yet. So it's giving an element of non-confirmation to what we're seeing particularly so prior to last night. Last night, we've seen the market get up close to those highs, but if you look at where we were last week, it was quite a bit below. So it was showing a bit of non-confirmation. And I haven't thought that was really a point of any great concern. It just seemed to be a market that was consolidating, following those strong gains we got following the election. But I'll show you what I think is fascinating. So we've just looked at how the NASDAQ, just looking at how the NASDAQ is yet to make that new all-time high. What is fascinating though, when we go over to the NASDAQ on an equal weighted basis, so we talked about the ASX 200 on an equal weighted basis, works the same way with the NASDAQ and the S&P 500. So rather than the biggest stock having the most influence, every stock is ranked equally. When we do that, when we go to the NASDAQ on an equal weight basis, you see that the market made so there's the post-election rally high, made a new high last Monday, and then overnight has made another high again. Also, it's rallying, having this strong rally off the 50-day moving average. And we've got this clear sequence of rising lows. which is all very much bullish price action, underpins what you get in those classic bullish trends. Seeing similar price action play out in the S&P 500. So just coming across the S&P 500, as I say, it's only just gotten above those post-election highs, but when you and also it's got that same classic bullish structure, rising moving average, rising highs and such. But it's also interesting when you go over and you look at the equal weight, S&P 500 equal weight. It made a new high above that post-election high as well. So you're getting the equal weight indices leading the market at the moment, which I think is quite interesting. In fact, the S&P 500 equal weight has been leading the way since August. So let me just quickly go back over to the S&P 500. So let me just get the S&P 500 back. So look at this high here. We've got a high there in July for the S&P 500, and it wasn't until over here in September when the S&P made a new high. Come over the equal weight. There's our July high. Equal weight made its high in August, so it preempted the high in the market cap indice. And so what does this tell us? What I think this tells us, I think it shows us that this is not a narrow rally led by a couple of big tech stocks. It's not just about Nvidia. It's not just about Microsoft or Alphabet. It's not just about those big stocks. The fact we're seeing this strength, and I think seeing the equal weight lead, I think that's telling us that this is a broad-based rally. And we're seeing those middle to smaller stocks. When we say smaller stocks, they're actually really big stocks in the S&P 500, but relative to the index, we're seeing those middle to smaller end stocks doing a lot of the work. And I think that's a really good thing, because broad participation is a hallmark of a healthy bullish market. My approach here: stay long. And long's a bit of a technical term, I guess, but long means owning stocks. It means maintaining exposure to the market, actively looking for opportunities. I want to give this prevailing trend the benefit of the doubt. This, of course, it never means being blind to risk. It doesn't just mean pile in, markets going higher. Never means that at all. Always got to use good risk management, because things can and they do change. And I think exit strategies are essential. But at this stage, for me, it's a case of staying on these big trends for as long as possible, and then having that plan for when they ultimately do end.
Yeah, fantastic. And obviously you mentioned exit strategies a lot. So if there is anyone new that wants to learn about them, we just did a show about 4 weeks ago. So go and look at, I think it's stop loss strategies, have a search there. And there's been plenty of other material in the past with us talking about stop loss strategies there and exit strategies. So don't forget to check them out again if you're interested in that. All right, let's have a look at the Hong Kong market.
Okay, going over to Hong Kong. Hang Seng is managing to hold above the 100-day moving average. I think this is an important area. If a near-term bullish scenario has any chance, I think it really does need to. I think the Hang Seng really does need to hold in around this 100-day moving average. I think a break below last week's low could see this September rally. A break below last week's low, I think, could see this September rally continue to unwind. What I really do want to see is a strong rally back towards 21,000 thereabouts, and that would break this sell sequence that's been in place since we saw the high in early October, and a strong rally would also give signs that that there's that buying interest really starting to return to the moment. Because at the moment, the rally's just been consistently sold into. For now, I'd rather watch this one from the sidelines. I'd rather watch how it develops. I don't want to get involved while momentum isn't on our side. If we get a nice strong rally, well, then we can start looking at opportunities. But at the moment, I think there are better places to be. When we look over at the Chinese market, it's similar. It's similar here, although it has been holding up little bit better than the Hang Seng. Again, it's sitting on the 100-day moving average. It's near this low point from October. So this is sort of like a natural support zone where it currently is. If prices can hold near these current levels, well, then that does open up the potential for an emerging upward trend to develop. But like the Hang Seng, I think it's just a case of wait and see. Often the markets don't present opportunities. When the setups are right, it's great. That's when we want to take action. When they're not clear and we have markets just consolidating, it's often best just to look elsewhere, and we can always come back when a market gets active. I want to see prices hold near these current levels, and similar to what I was saying in the Hang Seng, see a rally up towards 14,000 just to show that we're getting that real solid buy the dip interest and pushing the market higher. We don't have that yet, so let's wait and see whether we do it. Until then, I just don't think there's a hurry to do a great deal.
Yeah, I know you're not into the fundamentals, Jace, but I'd love to know your opinion. Whatever it is, you're probably going to tell me I don't really care, but that's okay. I'm going to ask you, why do you think these Asian-based markets aren't moving compared to the European and Australian American markets that are hitting all-time highs?
Look, the Chinese market hasn't really correlated with the Western markets for some time. I don't know. Look, there are other people who are more across fundamental factors. For me, it's about trying to interpret the price action. And so that's my competitive advantage, or that's my edge in the market, is that I can interpret price action. Doesn't mean I get it right all the time, but it's just about looking for those situations where you can see an asymmetric opportunity. The reasons behind those setups don't worry me so much. You can find a fundamental story to justify pretty much anything. So I don't really need the story. I just need the price action to be aligned in a way that provides those asymmetric situations where we can risk $1 to make potentially $3 or $4 and just keep playing those setups time and time again. And then over time, that's how I can do well, and how I can often beat the market. But trying to untangle the fundamentals of this, it's not. I'm probably not the go-to for that.
Yeah, no, I didn't mean to put you on the spot. It was more, I think actually you made the point was that you don't worry about what's happening in the news. It's just following the markets that are specifically doing well at the moment and ignoring the ones that aren't doing as well. And, when I look at the Japanese market and the Hong Kong and the Chinese market, everyone's going sideways. But if you're interested in other international markets, you're looking at the, European markets, and they're thriving at the moment, along with America and Australia. But your point made was that as our show is around technical analysis, we kind of really hone in and focus on those price charts. I'm sure you can find a story elsewhere to back up any cases, right? So point made. I will not ask you.
Rod, I do think that an understanding of price analysis, it can take you to pretty much any market. So we could call up a chart of soybeans or uranium, or we can call up the German DAX index, or we can call up some 30-year US government bonds. Doesn't matter what it is. We can call up the price action, and we can assess the price action fairly quickly. Whereas for me to become an expert in the copper market, well, that's going to take me a whole lot of time, and I'm not going to be able to do that in a few minutes. So I think I think for someone, even if you like fundamentals, being able to interpret price action and know when prices above rising moving averages, for instance, it does help you get a quick underlying understanding of pretty much any market you can think of without being a fundamental expert. No one can be a fundamental expert on every market on earth, but I can, if it's got a free market and it trades on an exchange, I can give you a price assessment, a price action assessment in no time at all.
It's a perfect point you make. It keeps on reaffirming my reasons why I do like technical analysis, because of those reasons, right? I guess with many other fundamental experts, they always have to know a lot about that background of the market and what's happening and whatnot, and they'll have to prepare for it. Whereas with us, we could just give you a chart, and you could, with all the skills, you can sort of analyze its structure and whatnot, right? So great point. Thanks for that, Jason. Well answered. Let's have a look at our first general question for today. Then comes from our good long-time viewer, Michael Lynn. I hope you could answer this, Jace. It's about how I should change my thinking and mindset. The big issue I have when I try to follow the trend is when I buy. I like to buy low, like most tight ass people, but sorry for anything offended there. But so often it doesn't reach my buy price, and the stock then runs away from me. It's a long question. If I buy at a higher price, then the stock can often fail. Is there a good or systematic way to enter? I know we've talked about this in the past. About the spread and the depth, and when buying stocks some time ago, but I'm still exactly not sure how to do it.
Yeah, look, it's like people sometimes ask me, should I buy on the open? Should I wait, and should I buy near the close? Should I buy in the middle of the day? And we only know the best time to buy in hindsight. I don't think there's a particular time of day that gives us the best entry point. Sometimes you buy in the open and the stock slides during the day. Other times you say, okay, look, I'll buy it on the close, see how it goes through the day, and it just rises all day, and you go, oh, geez, I should have just bought it at the open. So there's, I don't think there's a single simple rule. I'll show you. Like, I'll just call up a stock which comes to mind. It comes to mind because of the situation I was in myself. GTK, Gentrack Group. We've called this up several times over the year. It's been a terrific trend. Look at this, great trend in Gentrack. I got a signal to buy Gentrack, as did Motion Trader members. We got a signal to buy it on the I think it was on the 22nd of November, and I didn't buy it at that time. I don't buy on the same day as members. Members get the signal, so I wait a day, and then I just got distracted. I didn't put in an order, and it just shot higher. So, and this is what some stocks will do. So if you try to finesse your levels too much, and you say, look, okay, I've got a signal, I'll put a buy order in just back near the 50-day moving average, and I'll get the next pullback. Sometimes they don't pull back. Sometimes they go straight up. Whereas other times, say we got a signal, we wouldn't have because of the moving averages, but just for the point of an example, say we got a signal in mid-October, we say, look, we've got a signal, let's put an order in back near the moving averages, we'll get the first pullback. Well, sometimes you get them. And I think this is what the email is all about. It's like, it's the inconsistency of, is the stock going to pull back or is it going to run? Often I think the best course of action is just to get in and buy. But I do understand the question because I do it myself. I'll often put a bid in and wait to get filled. I'm inconsistent with how I do it. Actually, it's sometimes I'll pay the offer. Sometimes I'll put in a bid. I do look at the market depth of a stock, and if I see there's plenty of volume on the offer, I might be inclined to put in a bid. But sometimes I'll look at a stock and there'll be more bids. There'll be more volume to buy than there is to sell, in which case I'll be more inclined just to pay the offer and get set. If a stock starts to run, if I'm working a bid and the stock starts to move higher, well, then I'll often just say, look, this is not working. I'm just going to pay a bit more and get in, because I want to avoid this sort of situation like in Gentrack where it just goes. Most stocks don't do this, but the ones that do, they're the ones you want to be on. So I don't like to mess around too much with the entries. But as I say, there's no golden rule as to the best time to buy. So I think it's a case of, if you're not experienced at the price action, at watching the price action, and you don't want to watch the price action, sometimes it's just a case of paying the market price, assuming there's reasonable liquidity and you're not just buying a thin market and paying any old price. I don't think that's a good idea. But if there's reasonable liquidity, sometimes it's best just to pay.
I think that's the easiest way that we've talked about over the year that we've been doing this, right? For yourself. I mean, there is shows, if you look back on entry points, and Michael, feel free to just shoot us an email again, and I'll find them for you if you want to. But being consistent is the most important thing. And you said you weren't as consistent, Jason. That's what you said with some of your entry points. But I think from my perspective, I'm always looking for that pullback, and I'm ready to accept that I'm going to miss the odd occasion that it's going to pull away and never have that pullback, right? But I think along the lines there with the Gen track, you've had that opportunity a few times, right, to get in. Even it might not have been immediately there, but wait, if you want to put it on a watch list, it's come back eventually, right? So
yeah, and that's ultimately where I got in. I got in around this point here in January. So I had a signal in November, and I ended up getting in. So I missed the initial run. I didn't want to chase it higher. I thought I'll get in on the next consolidation, and I got in on the next. It took several weeks, but got in on the next return to the moving average. But throughout this brilliant trend, I haven't had my full position on, because it was I was buying then at a higher price, so I bought less. So it's the frustration of not buying when I should have, and not being able to maximize what has been one of the standout trends. So probably maybe the message is, don't be too finicky about how much you pay. If you're paying an extra couple of cents, really, it shouldn't matter too much in the scheme of it all. If you've got a situation where a stock's just charged higher, well, sometimes, and it's become stretched above the moving averages, I might get a situation like that, and then I say, look, I don't want to chase it this high. I think it will come back towards the averages. But if it's a stock which is say just looking for another period, like look at this period here where Gentrack had been in this trading range for several months. It broke higher. At this point, I don't want to mess around saying, look, I'm going to get it on the pullback, because it's just starting to break out of a consolidation structure. That's where I'm more inclined just to pay the offer and get in. I don't want to mess around at that point there. Whereas if it's gapped higher, well, then I might say, well, look, now I'll wait for some sort of a pullback. So there are times when I'll be a little bit more patient. There are other times where I won't mess around, because I don't want a situation where a stock just keeps rallying, and I'm waiting trying to save 2 cents.
Yep, exactly. No, great example there. And like you said, to the sake of a few cents here and there, sometimes it's best just to get yourself in. All right, fantastic. I hope that answered your question.
One more quick point I'll put in. And if you're not sure, sometimes you can buy half at the current price, and if you want to try and get it a few cents better, put the other half of the order in wherever you think that may be. So if it runs, you got half a position. If it pulls back, well, you got half of them at a better price. And when you, like on Selfwealth, and you're paying $9.50 a trade, you can kind of do that. It doesn't, because the brokerage isn't such an issue. So yeah, look, different ways it can be played.
Another good point. But yeah, check out some of the entry. Once again, going back to some of those videos where we talked about entry points might help as well for you to come up with an answer for your system there as well. Thanks for that, Michael, and thanks, Jason, for offering your opinion there. Let's get onto some of the tickers. We've got a few to get onto already, so let's have a look to start off with. We'll go and have a look at FND.
Yeah, well, this is sharp pullback to the moving averages. It's still above, like this is a motion trader stock, and it's still above the trailing stop. So I give stocks a lot of room to move around, typically be below the 100-day moving average. At the moment, it is still within an upward trend. You can see this period back in April, there was a sharp decline, which is not dissimilar to what we currently have. A sharp decline back to the moving averages. On this occasion, it quickly stabilized and started to push higher. Whether that happens again or not, I don't know. There is a lot of technical damage done there. It's not a dip I'm interested in buying at all because it's just too much of a sharp decline. For the sake of a little bit more room to the moving average, to the trailing stop loss, I'd continue to hold. I wouldn't, as I say, I wouldn't buy it. But the technical damage from a move like that, I think at best it does probably enter a longer period of consolidation before possibly turning higher again. I don't think this is a stock we'll see making new highs anytime soon, just given the extent of that fall. So I'd be happy giving it a little bit more room to see what it does, but yeah, it's not a situation I want to start to step into.
Okay. All right. Thanks for that. VUL.
Well, the trend here remains up. We're getting this pullback, which is not surprising because you can see that it did become stretched above the moving averages. And the moving averages are a bit like gravity. It always pulls price back towards it. You can only stay elevated above those averages for so long. Just like what happened back in May. Prices got stretched and they came back towards the averages. Now, whether we get a longer period consolidation that began from the May high or not, we don't know. Every consolidation is different. This could find support and track sideways while the moving averages catch up. From there, it could rally again. I'd like to see I'd like this decline to start stabilizing soon. Like it's not a good sign when a stock has a strong rally and then it comes down at the same pace. It really does take the air and the momentum out of a situation. That's not the case we have at the moment. So I'd be looking for it to really start to stabilize, probably somewhere around current levels while these moving averages catch up. I don't want to buy this dip yet because the consolidation could. I'd like to see how the price action develops, and if we do start to see some sort of a base start to fall, well then that could become a buying opportunity then. At the moment, if I had this stock, I'd be holding it. Wide trailing stop down below the 100-day moving average. I risk giving back much of my gain, but that's okay because that's the price you pay to stay on some of these trends, which can go a really long way. We don't know whether Vulcan's going to be one of those mega trends, but I'll give every stock that opportunity, and because that's where I'll make most of my money. So for now, the general upward trend remains in place. Let's just watch how this pullback develops.
All right. Let's have a look at SDF, Steadfast.
Been a bit of a tricky one there because we had a nice breakout in July. We ended up being a false break. I can just pull that along a little bit more. So yeah, we had this. You can see this. You can see there's a really nice trading range there. Broke higher from, consolidated along the breakout point. Often would see price action like this resolve to the upside, but that wasn't the case. There was a sharp decline. That would have been enough to trigger a motion trader stop loss. So I would have been out of that stock on that decline. It hasn't done enough to get me back in at this point. If I was in this stock, well, I guess if I was in this stock and I was looking for an exit point, well, I guess the exit point would be just back below the lows from October. It's a tricky one. We don't have a clear-cut trend. It's really been in this sideways phase for about about a year and a half. Year and a half of sideways with a false break to the upside. I'd rather leave this one alone. Maybe it's starting to regather some momentum, and this is going to turn into a larger move to the top side. But I'm not in the hurry. I'm not in the hurry at this stage to buy it. If I had it, well, look, maybe it could be a hold, still paying dividends probably, and I could use those recent lows as an exit point. See if it does regain some momentum. But as I say, not a standout for me.
All right. RHI.
And yeah, this is a no for me at the moment, because we've still got these moving averages declining. Prices come back to the averages, but that doesn't mean that it's about to turn high, because often we do get stocks that come back to the averages, and then, like in an upward trend, it's a case of buying the dips when prices come back to the moving averages. In the case of when a downtrend's in play, as the price comes back to the moving averages, it's often a case of sell the rallies. So it's still in that sell the rally phase. Yes, the moving averages are staying around higher, but for me, it's too early to consider buying this stock. So for now, for me, this would be an avoid.
Okay. JLG.
Just like I was saying with Red Hill, it's these moving averages still in decline, and we've got a rally back into the moving averages. Now, is this the start of a developing trend? It could be, but it's still going to take some time for these moving averages to continue to turn and cross and start heading upwards. It has, like, just looking at this box, which I put on previously, it just marks out a big trading range. Prices broke down from this trading range. So we're really just rallying back up towards the under section of that previous range. So it's certainly, at this point, it's not a buying opportunity. Like, the risk is that there's sell the rally comes in and the stock takes another extension to the downside. So I wouldn't be ready to buy it. I also wouldn't be holding it at this point, because I would have cut it. I would have cut my losses earlier on. If by chance I was in it, we'll probably look maybe looking at these lows from November, maybe a break back down through 340 could be a sign that the momentum is re-engaging to the downside. Or using the return to the moving averages as an opportunity to get out of a stock that I got stuck in. That's probably the way I'd play it. If I got stuck in this stock, I'd probably use the return to the moving averages as an opportunity just to clean it out of the portfolio. So I didn't need to keep looking at it and being distracted by it, and look for opportunities which are stocks which are rising above moving averages which are going higher. I think this is a problem a lot of people get. They get stuck in stocks that do have these big falls, and they just sit in their portfolio for years as they hope they come good again. And sometimes they do. A lot of the times they don't. Whether JLG will be one of the ones that comes good or not, I have no idea. But I do know that having a stock in your portfolio which is down 50 or 60 or 70%, it's every time you log on, you see it there, and it can be a frustration. I prefer just to clean them out relatively early. Take those smaller losses. Sometimes you get a larger loss, but if it's one part of a broader portfolio on a percentage of capital basis, it's probably still not that bad. Just clean out the dead wood and develop a portfolio with a strong stock bias. And a strong stock bias is owning stocks that are on the positive side of rising moving averages. And when they're on the underside of moving averages, just getting rid of them and rotating the capital into the ones which are above rising moving averages. And that's how I build a strong stock bias into my portfolio. It doesn't mean every stock will be a winner, but there's that bias towards strength, not weakness. And that tends to lead to better outcomes over time.
All right. Beautiful. Well said. Let's have a look at a few ETFs then. VGS.
VGS. So what is this? So this looks like an S&P orientated, but it's even stronger than the S&P. But it's definitely looks like a US based ETF, and well, like the US markets, it's a strong upward trend. I like this. Look at that consolidation we had through there, and then we had the breakout. So these are sort of like the consolidations I'm interested in buying, where markets go sideways back into the moving averages, or when they break to a new high after they've been going sideways for a while. They're great asymmetric setups where you can have relatively low risk for open upside. This trend, just like I was saying with the S&P 500, the US market, the Aussie market, we've got these underlying trends in place, so they get the benefit of the doubt until they show otherwise. And so this case, it's a case of just be invested in these stocks, let profits run. Would I be buying at current levels? Well, there's always potential for consolidation, but being like an index orientated ETF, smaller positions can be added at higher levels and just going with that overall trend. But bearing in mind that we could have said at some point during early 24, look, just going with that underlying trend, the trend does continue, but at some time you do get those larger consolidations, which even if the market runs now, the consolidation could still come back to current levels at some point. So it's why I like to buy breakouts from these ranges rather than just jumping on after they've been running for a while. But trend's nicely in place.
Yeah, VGS is an international ETF that's based on stocks other than in Australia, but it's also in other countries, not just the US. So just to clarify on that, obviously you can go and have a look at the Vanguard website for more info on that VGS product. But there's also VAS as well, which is another Vanguard product, right? So VAS, let's have a look at that.
And that is an ASX 300 ETF. Yep. And everything we said in the ASX 200 earlier applies to this. Upward trend still in place. You can see, like a nice consolidation zone, which the market is really just starting to push out from. So all those underlying characteristics of a rising or a bullish market remain in place until it tells us otherwise. Like you look at what the market was like back in 21. It's you don't know, and this isn't to say the current market's going to do what it did then, but like I would have been saying something similar there. Like we've got a rising market, it's coming out of a consolidation, it's pushing to a new high. Go with the trend until it tells us otherwise, and it continued upwards for some time before it told us otherwise, and we started to dip below the moving averages. Then we fell below the averages, the moving averages cross, and then that was it's telling us something else has happened. That upward trend is no longer in place. There's a larger consolidation happening, and that took time to play out. So where we are now, we've got market rising above rising moving averages. Trend is up.
All right, fantastic. Let's have a look at Bernadette's, which is B4P. B4P.
Before pay. So this is a motion trader stock, and got another entry signal last night in this stock. So the initial entry would have been probably back in August perhaps. It's interesting, big basing structure. There's a big basing structure in place over a year or so. Prices started to break higher from that somewhere around August, which is around where the first motion trader signal was. Moving averages are up, had that initial pullback to the moving averages, created that buy the dip opportunity, rallied off there, another consolidation back towards the averages, but didn't quite, the averages kind of caught up, but it didn't come back to touch the averages, and now it's rallying again. If I was in this, I'd very much be holding it. I'd be using a wide stop below the 100-day moving average to give it lots of room to move. It's one of those stocks which who knows where it could go. Could go a long way. So that's why I'd want to stay in as best I could with those wide stops. In terms of entry, look, I'd rather just wait for another consolidation like we saw in November and prior to that in September. I like to get these moves early on as they're breaking out. So maybe a couple of days ago, but now it's put on those extra few percentage points. I'd probably wait for some sort of a consolidation, just so it's to make it as asymmetric as possible in terms of like as minimal risk as I can get for as much possible upside. At the moment, it's like I just feel I've got to have the stop loss. I've got to give it that little bit extra on the stop loss. So it's 30% back below the 50-day moving average. So I'd rather just probably hold off an entry at the moment. But yeah, it's a great example of the sort of stocks I like looking for. Big bases, breakouts. Go with the breakouts, see whether you get trending conditions. If you don't get trending conditions and it comes back, relatively small loss. If it starts to run, well, then you never know, they can go anywhere. Like we saw at GTK earlier on, you can get really big gains, and you don't need the whole portfolio to do that. 1, 2, 3 stocks go gangbusters, and then you got modest returns and small losses. You can have a market beating portfolio.
Yeah, I guess this is also a stock that's similar to what Michael asked about, right? At what point do you get in? But I always like you're going back to the consolidation rather than just getting it on the breakout there. But you've got to have that system and be consistent with that system, right? So, yeah. All right. Do you want to have a look at IDA? IDA from Newell.
So just like, so on that, I'm just looking at this here. It's like, say we were looking at it, and this is all, I'm doing this in hindsight, of course. We've got the pullback. It's kind of how I think about stocks that I buy. If I'd had a signal and I thought, look, it's a bit stretched, I'm just going to see what it does, and it's pulled back. I probably haven't bought the pullback. I'm watching it. Then I've got a strong update. You can see this strong update. Then I'll see this strong update. And I think, well, okay. Maybe if it breaks to a new high on the next day, maybe that's my entry point. So maybe I'm getting in around where you can see the pointer is now. So I'm getting in just as the momentum's kicking in. So I'm not trying to get the lowest point because I don't think I can regularly get that. Sometimes I might, depending on what the consolidation looks like, I might put in a bid. But often I'll wait for that strength to start coming back in and go with it. But now, sorry, what was that? Was that IDR?
IDA from Newell.
IDA. Let's just compress that a little bit. Yeah, look, those trending conditions are in place. There's that classic consolidation, which I often point out, where you get that initial rally, pulls away from the moving averages. And this is where I look at it often and go, look, okay, this is where maybe there is a buy the dip opportunity as it comes back to the moving averages. So wanting to buy a dip, it's probably in that range. That's probably where I'd be looking to buy the dip. But that doesn't mean it's going to go straight away, because look at it, it can continue sideways for another month or so. But that's the pullback into the moving averages, where you can say, look, it's come back into the averages. I can have a stop just below, see whether this one gains momentum again or not. Alternatively, you're getting it on the was a bit of a tricky one. This one on the breakout, you're getting it as it's starting to gain momentum again. But then we had this sharp swing around, which so that's a messy area. Sometimes you get messy areas, particularly in lower price stocks, like it's an 8-cent stock. Looking at it now, the trends in place. Got this sideways consolidation just back into the averages. So look, maybe using the same theory that I was speaking about from earlier in the year, like someone likes a stock and they want to buy the dip, it's probably around this point where it currently is. There's probably like buying potential within that square, which is between say 11 cents and 10 cents. Alternatively, you can watch it, and if it goes sideways and then breaks up, maybe it's a buy at 11.5 cents. Every half a cent on a 10-cent stock, percentages do add up. This is the thing with the low price stocks, but it's who knows whether this goes onto a long-lasting trend, but at the moment there is upward momentum in place. So if somebody wants to get that momentum and go, see how far it can travel, this is a potential entry point.
All right, fantastic. OBM, please.
Well, it's pulled right back onto these moving averages. Just looking at the price action just in the last week, it's like had a really not much bounce to the that rebound at all. It actually looks like it wants to try and test lower again. I wouldn't want to be buying this dip at the moment. If I had it, I'd still be holding it. I'd have my wide trailing stop in place, because sometimes these stocks it could feasibly make a new low and then stabilize and start moving up again. We don't know. We never know. So wide trailing stop below the 100-day moving average and see whether stability comes in. If it starts to rebound, well, then we can consider it from an entry perspective. But at the moment, it's not the rebound I'd like to buy. I like buying those probably more like these flat sideways movements. You get a strong move, and then you get that sideways movement into the moving averages. I like to buy that because you can see it's not giving back. It's not giving back any of its gains. People are keen to accumulate the stock. You've got bids just below the market, and they're soaking up any stock that comes onto the market. So that's where I prefer to do buying. When a stock comes back more abruptly, well, there's more willingness to sell a stock and less willingness to buy it because it's not being supported. It's not the stock's not being soaked up as much. So I'm more inclined to leave these ones alone. This isn't the dip I'm so keen on buying, whereas the one from earlier in the year, where's that 20? Yeah, earlier in the year, more inclined to buy that. You see another one through here, through June, sideways in the moving averages. Bit messy in July, so nothing's, often things aren't always clear cut, but that's where I prefer to do buying, where you can see the price is going sideways as opposed to a more rapid decline. At the moment, I'd give it the benefit of the doubt if I was in there, but yeah, I'd just hold off buying it at this point.
All right, another one from Neil. NDQ, please.
So NASDAQ ETF. Look, same as I said with the US markets, trends up. I'd be giving the underlying trend the benefit of the doubt, letting my profits in this run, and who knows where this all goes. But at the moment, we've got rising moving averages and price above those moving averages. Stay long, and for me, it'd be stay long and wide trailing stop. Look, and also with a market ETF, it's not always a case. Not everyone has to have a trailing stop in place. Some people will buy an ETF as a long-term buy and hold. So I think an ETF is very different to an individual stock. So would I buy a NASDAQ stock and just put it in the bottom drawer and hold it for 20 years and not look at it? I don't think I would. Could I do that with the NASDAQ ETF, which is a collection of 100 or so stocks? Well, yes, I could. And that's how a lot of super funds are built upon. They buy and hold broad market exposure. So these ETFs are often, they can be quite different in how they're managed, I think, to a lot of individual stocks, depending on what your objectives are, what you're trying to achieve. They can be more suitable to those longer term passive holds.
Yeah, exactly. So let's get on to SHL then, please.
Well, it's a stock which has been, it's struggled for a couple of years, big downward phase. So is this phase ending? It's possible. So Price has gone from below the averages to above. It's travelled sideways. The moving averages have travelled sideways. The moving averages now appear to be kicking up again. Prices above those averages. It's early stages. It's early stages, but this could develop into something. It may not also. So there was a potential turnaround going on in early 2004, but it never really got going and started to decline again. I think this looks structurally a bit better than it did in 2004, but we don't know. I don't know whether this one's the one that's going to gain momentum or whether this is all still just going to be part of a larger sideways move that takes more time. But it's certainly has potential. So current levels, the stop could be just back below the 100-day moving average. So if it's back below the averages, well, it continues sideways. But if it can get some momentum going, well, then you got the makings of an emerging trend. So it's a stock with potential, but I do think it's fairly early. We could also say there's breaking out of this. There's a bit of a sideways range there as well. That's a bit of a zigzag type corrective phase, breaking out of that range. So look, I think maybe going with this breakout, stop loss just back around the moving averages. It's relatively low risk for potential upside. So yeah, it's worthy of consideration.
All right, fantastic. We're having a look at one on the NASDAQ, please. PENN.
Penn Entertainment. Well, it's certainly come from great heights, and it's been a long period of just nothing to see here with it below those declining moving averages. Not dissimilar price action what we just saw. It's really interesting. So it's gone from below the averages to above, then it's gone sideways along flat moving averages. Averages just saying to kick higher. I actually prefer this. Whilst they're quite similar in structure, I actually prefer this a little bit to SHL in that we can just see just in the last month or so, you can just see these rising lows, and it's got a clearer sequence of rising highs. So is this a sign that buyers are stepping up at increasing levels to purchase the stock on pullbacks? I think this is an interesting play. Like I could bought it current levels. Like this is one where I wouldn't be putting in a bid below the market because it seems like there's some momentum coming in now. I'd probably just pay the offer. For the sake of a few cents, I just want to get in. Like a few cents might mean an extra 0.5% of risk or 1% of risk. It's like, really it's like no big deal. Stop loss could be about 15% below the market, so below this recent low. So to get stopped out, the stock has to reverse back below the moving averages and break the sequence of rising lows. So 15% seems reasonable. Now, because it also could be in the liftoff phase after being in we can say like it's been in a somewhat of a range, and it's now starting to lift out of that. So it's one of those ones with the potential where it could quickly be up around 26. That's why I'd be inclined to pay the offer. And then from there, maybe it consolidates and then up again. Like who knows? Anything could play out. But that sort of pathway is possible. So I think it's asymmetric in terms of, we can say 15% of risk. Upside could be considerable. Could it double from here? Yes, it could double. So 15% of risk into 100% of possible upside. That all works out. And of course, the trade might not work out. It could flop. But if we play setups like this time and time again with great asymmetric properties like relatively low risk, high reward, I think we really put ourselves in the game to do well over time. Individual outcomes will vary, but as a collective of playing that sort of systematic entry process and identification process, I think stocks like this can really do well for us.
All right, beautiful. All right, I think we're going to finish off on one here, which is SXE back on the Aussie market.
Vulnerable times for this. because we now have the moving averages have turned lower. They're close to crossing, prices consolidating below the averages. Not a dip that I want to buy, even though it's had that nice rebound. Like if I had this, the way I'd look at this would be that I think that, well, this was a motion trader stock, and I think it was stopped out on this pullback. Would have hit the stop loss. It's now had the rebound. Sometimes when I've been in a stock like this, where it's had that big fall and it's fallen quickly, it's got stretched below the moving averages. Often we get that rebound back towards the averages. Sometimes I've used those sort of moves just to exit a position, which I didn't sell as it went down because it went quickly. So I'll often be a seller into the rebound. Now, this could now stabilise and turn higher. Can't rule that out. My concern, though, would be that it's vulnerable whilst it's below the moving averages. My concern would be that it maybe tracks sideways and then has another tilt to the downside, or it gains momentum to the downside sooner rather than later. So I'd be inclined I wouldn't be buying this dip, and I probably wouldn't be in this stock now. It could recover from here, but there's certainly a vulnerability whilst it's below these moving averages, which are turned to the downside. I think we've got to think about, okay, if I'm in this stock and I'm holding, where do I say enough's enough? Where do I say, okay, I'm going to cut this? Is it down at the November low? Is it further down, or do I not have a plan? If I don't have a plan of where to sell, the risk is that it does start to unwind, and in 3 or 4 months it's down at $1. Now what am I going to do? Was it $2? Now it's at $1. This is when people say, well, look, I don't want to sell now. I'll just hold this and wait for it to come good. Then what happens? What if it goes lower? This is where we spiral into bigger problems. So have in mind, if in this stock, I'd be thinking, okay, where's my get out point? Where do I say enough's enough? I'm just got to rule off and do something else. This is where we can get in trouble when we're below declining moving averages. It's a vulnerable and I think a riskier time.
Okay, we do have one more, and it's actually called USD. Let's look at USD.
Yeah, so US dollar ETF. Yeah, it's an interesting ETF because it doesn't look like the US dollar index, which I track, which is a basket of currencies against the US dollar. This has been more tracking side. Well, the US dollar index has been tracking sideways too, but does look different to this. Big range here. We don't have a breakout in either direction. Would this be? No, it's not the Aussie dollar either. It's it'd be interesting what the makeup of this ETF is. It doesn't look like the Aussie dollar, and it doesn't look like the US dollar index, but some way of getting exposure to the US dollar, I imagine. At the moment, this is range bound. We don't have a trend in either direction. So I think probably nothing to see here at the moment. But could it be a case of there's been an initial rally and sideways, and this ultimately does break to the top side? That could still be some way off because, as I say, it's sideways at the moment. But look, I don't see the trade here just yet, but it's one to watch because when ranges break, they often lead to good trending environments. And at some point, this range will almost certainly break. Does it lead to a good trending environment? Maybe. So from that perspective, it's probably worth keeping an eye on.
All right, fantastic. I think we are good. Just want to shout out to Neville. Thanks for the compliments and thanks for your continually learning and obviously great to see your portfolio improving. And he's given us a compliment on our shirts. Kind of reminds me of the Matrix, whether you want to take the blue pill or the red pill. That's your choice, obviously. Obviously summertime now. We'll be back with more colourful shirts as we in the coming weeks. As always, remember this is always general advice only. Please do your own research, do your own thing. We don't know your circumstances, obviously, so make sure you take this as a grain of salt, as they say, with a grain of salt, but we hope that you're getting something from our education as well, obviously, because it is very valuable education. If you are interested in a motion trader, there is a question there from David. Look, David, shoot Jason an email and see, and obviously inquire about his membership on that side. There's a free trial and a link down below you can use for him. And then obviously, if you are not trading with Selfwealth, and I'm part of Selfwealth, come and have a try of our platform. It's completely free. If you're trading with Selfwealth and you've got other portfolios, why not make 2025 a year of consolidation where you're bringing all your portfolios across to Selfwealth, all right, and make your life simple, as Jason did. It's one of those things that I'm here to help people with their platform at Selfwealth. That's my role here at Selfwealth, if you're ever questioning that. So if you do want to ask me a question, just send an email to support@selfwealth.com.au, attention it to Roger, and I will be the one that's responding to that as well. All right. So here to help as always, and there's a link below to sign up. That's my call to action. I hope everyone's enjoyed the show today, and thank you for everyone for coming. Thanks a lot, Jason.
Rod, just been fun. Thank you everyone for being a part of it. It's been a fun hour or so.
All right, beautiful. And we will see you again next week, and we've just got to work out what kind of shirts we'll wear. Thank you very much, everyone. Have a great week ahead. Take care. Bye-bye.